If you receive SSI, SSDI, or Social Security retirement benefits, this is something you need to focus on right now. The rules have officially changed, and this isn't speculation or something coming later. It's already happening. The Social Security Administration has introduced a major shift in policy, and millions of Americans have no idea how these updates could directly affect their monthly payments, their eligibility, or their long-term financial stability. We're talking about changes that could either put more money in your pocket or lead to painful reductions if you miss key deadlines. Whether you're already receiving benefits or planning to apply soon, this impacts you personally. Are SSI income limits changing? What's happening with SSDI work rules? And how will your Social Security check be affected starting this month? These are exactly the questions we're going to break down, clearly, simply, and in plain English. No confusing jargon, no unnecessary complexity. Everything will be explained step by step so you know where you stand, what's changing, and most importantly, what actions you need to take right now to protect your benefits. Let's dive in. So what's actually happening right now? The Social Security Administration, SSA, has rolled out a set of changes that take effect immediately. These aren't small adjustments. These are meaningful updates across three of the most critical benefit programs in the country: Supplemental Security Income, SSI, Social Security Disability Insurance, SSDI, and Standard Social Security Retirement Benefits. All three are being updated at the same time. And that's exactly why this moment matters so much. Let's start with SSI. What you need to know. SSI is a needs-based program. That means it's not determined by how long you worked or how much you paid into Social Security. Instead, it's based entirely on your current financial situation. For years, honestly, for decades, the rules surrounding SSI have been extremely strict and in many cases, deeply unfair. One of the biggest frustrations for recipients has always been the resource limits. Until very recently, if you had more than $2,000 in savings, you could lose your SSI benefits completely. For couples, that limit was just $3,000. Think about that for a second. In today's world, where a single emergency, like a medical bill, a car repair, or a home issue, can cost thousands, SSI recipients were essentially being told they couldn't save money, not even a small safety net. If you tried to build even a modest cushion, you risked losing everything. That wasn't a system built to help people move forward. It was one that kept them stuck. Now here's the good news, and this really is good news. After years of pressure from advocates, lawmakers, and families, the SSA has begun updating how these outdated rules are applied. While full reform still requires legislation, the agency has already taken steps to change how certain resources and income are counted under SSI. So what does that mean for you? It means greater flexibility. Certain assets may no longer count against you the same way they used to. There are also important updates to how specific types of income are treated. Let's also clarify the payment side. The base federal SSI benefit has been adjusted. As of this year, the maximum monthly federal SSI payment is now $943 for an individual. For eligible couples, that number increases to $1,415 per month. These increases reflect the annual cost of living adjustment, COLA. Now, let's be honest. $943 a month is still not a lot, but it is an improvement. And when combined with the rule changes happening now, the overall situation for SSI recipients is slightly better than before. One of the most important updates involves something called in-kind support and maintenance. This has been a major source of confusion for years. Basically, it refers to help you receive from others, like free housing or groceries provided by family or friends. In the past, the SSA would reduce your SSI benefits because of this support. In other words, getting help from loved ones could actually lower your benefits. That never sat right with people, and for good reason. Now, under the updated approach, the way this support is counted has been simplified. In many cases, certain types of family assistance no longer trigger the same reductions as before. This is a meaningful improvement for people who rely on support systems just to get by. Now let's move to SSDI, specifically work rules and income limits. SSDI operates very differently from SSI. It's an earned benefit, meaning you must have worked and paid Social Security taxes to qualify. Your payment is based on your earnings history. SSDI is designed for individuals who are unable to work due to a serious medical condition expected to last at least a year or result in death. One of the biggest concerns for SSDI recipients has always been this question: what happens if you try to go back to work? A lot of people want to test their ability, maybe part-time, maybe gradually, but the rules have always felt complicated and risky. The fear is real. What if I try working and it doesn't work out? Do I lose my benefits? Do I have to start over? Will I be stuck waiting again? The SSA uses something called substantial gainful activity, SGA, to determine whether you're still considered disabled. For 2026, the SGA limit has been updated. For non-blind individuals, it's $1,620 per month. For individuals who are blind, the limit is higher, $2,700 per month. These numbers are extremely important. If you're thinking about working while on SSDI, you need to know exactly where that line is. There's also something called the trial work period. This is one of the most valuable protections available, and many people don't fully understand it. The trial work period allows you to test your ability to work for up to 9 months. These months don't have to be consecutive. They can be spread out over a 5-year period. And here's the key point. During those months, you still receive your full SSDI benefit, no matter how much you earn. That's huge. The income threshold that defines a trial work month has also been adjusted for 2026. Why does this matter? Because this isn't just about money. It's about independence and dignity. It gives people the chance to try working again without the fear of losing everything they depend on. The recent updates aim to provide more flexibility and breathing room, and that's a step in the right direction. Now let's talk about Social Security retirement benefits and what's changed there. This is the program most people are familiar with. The biggest update each year is the cost of living adjustment, COLA. For 2026, that adjustment has already been applied. COLA is based on inflation, specifically the Consumer Price Index for urban wage earners and clerical workers, CPIW. This year's adjustment means higher monthly payments for over 70 million Americans. The average benefit has increased, giving retirees a bit more room to handle rising costs like food, utilities, and healthcare. But here's something many people overlook, and this part really matters. Yes, your benefit may have increased, but other costs can reduce that gain quickly. The biggest factor? Medicare. Part B premiums. For most people, Part B premiums are automatically deducted from your Social Security check. If those premiums go up, they can eat into your COLA increase, sometimes significantly. So even if your gross payment is higher, the amount that actually hits your bank account might not be as much as you expected. There is a safeguard called the hold harmless provision. This rule ensures that your Social Security payment doesn't decrease from one year to the next due to rising Medicare premiums. However, not everyone qualifies for this protection. If you're newly enrolled in Medicare, or if you have higher income and pay additional premiums under IRMA-A, the income-related monthly adjustment amount, you may not be fully protected. That's why it's important to understand how IRMA-A applies to your situation. This might be something worth reviewing with a benefits expert. Now, if you're still working while collecting Social Security, there's another rule you need to know: the earnings test. This applies if you're collecting benefits before reaching your full retirement age, FRA. If you earn above a certain limit, the SSA may temporarily withhold part of your benefits. For 2026, that earnings limit has been updated. Exceeding the limit doesn't mean you lose money forever. The SSA adjusts your benefits later, but it can reduce your monthly payments in the short term. Once you reach full retirement age, this rule disappears completely. You can earn as much as you want without any reduction. But for those who claim early, which many people do at age 62, this is something you need to plan for carefully. Now let's talk about one of the most important decisions you'll ever make: when to claim Social Security. You can start as early as 62, but your benefit will be permanently reduced, often by 25% to 30%. Your full retirement age depends on your birth year, typically between 66 and 67. If you delay claiming beyond that, your benefit increases by about 8% per year, up until age 70. After 70, there's no additional benefit to waiting. So your options are simple: claim early and receive less for life. Claim at full retirement age and receive your standard amount, or delay and receive significantly more. The right choice depends on your health, finances, and personal goals. Now, let's not overlook spousal and survivor benefits. If you're married, you may qualify for up to 50% of your spouse's benefit, if it's higher than your own. If your spouse passes away, you may receive up to 100% of their benefit. These are extremely valuable and often misunderstood. For divorced individuals, there are also rules that may allow you to claim benefits based on your ex-spouse's record, as long as the marriage lasted at least 10 years and you are currently unmarried. Many people don't realize this and miss out on money they're entitled to. Finally, a critical warning: Social Security scams are everywhere. Scammers may call, email, or text pretending to be from the SSA. They might say your benefits are suspended, that you owe money, or that you need to verify information. This is not how the SSA operates. They will never demand payment over the phone or ask for gift cards or wire transfers. If you receive a suspicious message, do not engage. Hang up, delete it. Contact the SSA directly using their official number. Now, let's wrap this up with what really matters. The Social Security system represents years, often decades, of your work and contributions. The changes happening right now are part of a broader effort to modernize the system. Some changes are positive: more flexibility for SSI, updated SSDI thresholds, higher payments through COLA. Others require attention and awareness, but the most important thing you can do is stay informed. Understand your benefits. Claim what you've earned. Ask questions. Get guidance if needed. You've paid into this system. You have every right to receive what's yours. Don't let confusion or fear stand in your way. Reach out, stay engaged, and make informed decisions for yourself and for your future. Because this isn't just about policy changes. It's about your retirement, your security, and your peace of mind.